Welcome back, ladies and gentlemen. My name is Joshua Castillo. If you haven't seen my channel before, I am a value investor. I also look at the financial, big financial investors. I like watching their moves that they're making or looking at their letters that they put out and getting some ideas of what they're doing and how they see the market in this current environment. Also, another note, if you haven't already noticed, I got a new mic. It sounds a lot different. So let me know what you think down in the comments below. I'm going to try to fiddle with it just a little bit audio wise, but I'm hoping this sounds a lot better than how the camera audio was sounding. So without further ado, let's dive right into today's topic, Teradyne Inc., and what my thoughts are on it. Now, normally I would have an iPad that I could, share things with you guys and kind of read through it and you'd see me reading on it. But today, since I'm obviously in a different format, I'm not sitting, against where my computer's in the background. I'm going to be using my actual, desktop to give me all the things that I need. So as far as notes go, that's why I'm looking over here in case you're wondering why. Now let's dive right into it. So Teradyne Inc. is a company that sells automatic test equipment. That was kind of like the main focus of the business. They have since bought Universal Robots and some other acquisitions in sort of the cobot field that allows them to have some sort of competition there, as well as kind of build out some robots that really help people in assembly lines and other things that they're doing in other tasks. But really, those are the two portions of the business that matter the most, and this comes from their 10K. We design, develop, manufacture, and sell automatic test equipment and robotic products. Our automatic test systems are used to test semiconductors, wireless products, data storage, and complex electronic systems in many industries, including consumer electronics, wireless, automotive, industrial computing, communications, aerospace, and defense industries. Our robotic products include collaborative robotic arms, autonomous mobile robots, used by global manufacturing, logistics, and industrial customers to improve quality, increase manufacturing and material handling efficiency, and decrease manufacturing logistics costs. So again, not a terribly complicated business to understand as far as that goes, but really what you need to understand is how important it really means to have a company that is sort of, it's sort of the picks and shovels rather than like the actual gold. You know what I mean? Like they're creating the equipment that people need to be able to do their jobs, and that's kind of what they're pushing for, and that's what they have been building on that with that robotics acquisition. Now, as for the company, they break themselves down into two, different pieces, as I had mentioned earlier, but within those pieces, you'll see different segments. So the first segment is going to be the semiconductor test segment that includes operations related to design, manufacturing, and marketing of semiconductor test products. The system test includes operation related to design, manufacturing, and marketing of products and services for storage and system level tests, defense and aerospace instrumentation tests, and circuit board tests. The wireless test is going to relate to, 5G or any sort of networking things that they have. And then they have the robotics segment, as I mentioned earlier, which is going to be sort of your cobots and robots that they're building, those semi-autonomous or autonomous mini robots that they're building. So really, again, it's going to be a lot of what you see here. So if you want to take a look at what those segments look like as far as dollar-wise and what they're making. So in 2022, the semiconductors made $2 billion. System tests made $469 million. The robotics made $403 million, wireless tests made $201 million, and then corporate eliminations, obviously, you'll see that there. So in total for 2022, $3.1 billion is what they made. So a broad majority of the revenue and sales is going to come from that semiconductor test. And you can see that, obviously, looking at the last few years, you had $3.1 billion in 2020, $3.7 billion in 2021, and then now $3.1 in 2022. And we're going to get into that later on in the video of why that sudden decrease, but really a lot of it relates to just how the cycle of the whole entire semiconductor market really works, especially because semiconductor testing is more than half of their sales. So I'm going to dive into that a little bit later, but I figured I'd pop this up now so you can see kind of what the business has been doing over the last couple of years, and this is something that they share on their 10K. So if you go back on the last couple of 10Ks, you can really see this sort of explanation as far as the segments go. Now, as far as their most recent quarter and what they have done, their fiscal year 2022 has come up. As far as their last quarter goes, though, they're at about $3.155 billion, as I had mentioned earlier. You can see here on the screen what that looks like as far as year over year. The most recent quarter was a negative 17% year over year. Again, 2021 was an exceptional year for a lot of businesses, especially semiconductor businesses. Their profit margin, though, has been floating anywhere from 20 to 25% over the last few years. As you can see here, seeing that gross margin, that net margin kind of tick up over the last couple of years has been really helpful, especially as, the Universal Robots acquisition, and that whole segment of their business has been building up and ramping up. So I'm excited to see that. It's important to see that, but that contributes a lot to their margins because they're, going to get more efficient in that side of their business. Now, as far as their current PE, 24, 25 PE is what I've been seeing. You can see here kind of right around the average is where they're at now. So around 24, 25 PE is, where they've been sitting. Enterprise value to EBITDA around 15 to 16. Current cash on the balance sheet is $854 million. Now, as far as the debt goes, you can see here on December 12th, 2016, Teradyne completed a private offering of $460 million, aggregate principal amount of 1.25%, convertible senior unsecured notes due December 15th, 2023. So that's going to be this year unless they decide to refinance and pay off the current loans. As of February 22nd, 2023, 124 holders had exercised the option to convert $424.9 million worth of notes. You can see here what that looks like as far as their debt goes. I do think it's important to understand kind of where all this is at. So again, a lot of this is going to be current heading into 2023, which is the year that we're in. So right now, the current debt is really basically $50 million. And you'll see kind of, as things move around, if they decide to go with more debt or if they keep the balance sheet a little less leveraged than other companies. Now, from what you can see here, there's a lot of capital priorities that they're doing with their free cash flow, one of them being repurchasing shares and issuing a dividend. Now, you can see that the dividend is going to be increasing over the last couple of years. In reality, the last 5 years, it's been compounding at about 9.46%, which is great. The yield is only 0.45%, which is not too great, but again, as it keeps growing, you'll get a little bit more and a little bit more and a little bit more, and especially if the company grows, you'll get that as well. Now, as far as the repurchasing and where that's all at, in January 2023, the board of directors canceled the original 2021 repurchase program and approved a new $2 billion repurchase program for common stock. So basically, you can see here the last couple of years what they have done with that. So buybacks has made up a majority of the capital that they have been deploying to shareholders. And then obviously dividends has been a piece of that. And then last but not least, acquisitions. But we don't necessarily benefit directly from the acquisitions. The company itself benefits over the long term from these acquisitions. So you can see though how they're using that free cash flow. And it's very, very, very similar to KLA and kind of what they were doing and how they were, how they were operating in their cash flow. So not really that surprising to see them use that free cash, and doing so without a really heavily leveraged balance sheet makes me feel way better looking at a company like this. Now, looking at their sort of industry and what they've been doing, I'm going to look at two different industries. So you have sort of they call it 8, it's automatic test equipment or automated test equipment. So 8 is what I'm going to be looking at for the semiconductor and kind of the system test side. And then you're going to have the robotics side and what that all looks like. So the global automatic test equipment market size was about $6.44 billion in 2020, and it's projected to be $9.52 billion in 2023. So, CAGR of 4.2%, but that's why you're seeing companies like KLA and like Teradyne and like all these other companies within the space getting into kind of a more diversified portfolio of offerings so that they don't get stuck on either a slow growing or something that may be more cyclical than others. So that's why you're going to see on the robotics section here, the cobot market size was valued about $1.6 billion in 2021, and it's projected to be $16.8 billion in 2030. So that's a CAGR of about 40% from 2022 to 2030. So I'm excited to see what they're going to do it. And again, if the market share stays the same, but the pie grows, they're going to make more money, which that's what you want to see as a shareholder. And that's also what you want to see at the business level, because that's going to allow them to invest more and more into their company, into their equipment, and just into their partners in general. Now, one of the great strengths that I wanted to point out, and it's more of a testament to what the management was able to do with the acquisition of Universal Robots, but something I wanted to touch on as a strength, because it's half strength, half weakness. In my opinion, I think a lot of it relies on how well Universal Robots does. But the thing is, for this robotics piece of that business, are they going to have to keep acquiring to get market share or to be able to keep up with their competitors? That's kind of the question. But for me, from what I'm seeing, I think that the management has their heads on correctly, and I think that they're making acquisitions when they see an opportunity there. So you can see that they acquired Universal Robots and for $285 million. And then you can see here on the segment revenues what they have been doing. Robotics has $403 million just in 2022 alone. Now, the income and loss, a lot of that comes from the fact that they're still investing heavily, but they have the cash flow from the other pieces of their business to be able to pour into Universal Robots and their, the robotics arm in general of the business. Now, again, because they're operating at a loss, there is some risk there that it can continue operating at a loss if they decide, they need to add more people, increase R&D spend, or just increase CapEx in general as a piece of their business. But I actually found a really good article from Nanalyze.com that said, they've been following the story, and it looks like the CEO has set out some aggressive goals for the robotics division. The big announcement for the company was that it believes that revenue for robotics will hit $1 billion, representing about 20% of the total revenues by 2026. Now, the new CEO, Greg Smith, was actually part of the industrial automation segment of the business, so he knows what he's talking about. But for me personally, I think that hitting $1 billion in 2026, it's probably going to be a really tall task to order, especially given where we're at right now. If people start cutting back on CapEx, they might not want to invest necessarily into cobots, into robots, into their logistics. It'll really be the people who are like more long-term focused, who know that this is a necessary product, that are going to probably buy it. But I don't know realistically how many people right this second are going to be buying. It might be one of those things where, Mark II, Mark III, Mark IV might actually have some improvements that people start stepping in and buying a whole lot more. And maybe that's what the industrial automation side sees. But the new CEO says that, they can probably hit this target. They're hoping that they can hit this target. It'd be about a 25% compounded annual growth rate year over year, basically from now until 2026. So personally thinking, I think it's a pretty tall task to order, but Nanalyze actually had something here where they, basically are projecting from, around $400 million. It's going to hit close to $1 billion in 2026. That'd be a pretty big growth. And if they're able to hit that, that's definitely a catalyst for growth going into the future. Because again, if they're thinking it's going to hit 20% of their total revenue, that's a pretty big increase as far as their bottom line goes. Now, another component that I wanted to add as far as the strength goes was the high barriers to entry. And a lot of it has to do with the way that semiconductors and just the whole entire equipment market as well kind of works, and how patents work and everything's protected. But one of the big things I think is the people that they keep. So here on a Forbes magazine, they did a great job of explaining what this turnover actually looks like. So Teradyne makes considerable investments to develop new products. As Jagular told me, new semiconductor test equipment is very complex. It takes 400 to 600 engineers, 4 to 5 years, and costs $1 billion. We've been fortunate to suffer very low turnover, around 2% among our engineers. This gives us accrued knowledge, which benefit to product development, deepens our domain knowledge, and enables us to be a more advanced than competition. The industry has consolidated since 1990s. As he said, there are high barriers to entry. In between Teradyne and Advantest, we control 90% of the market, which is growing at 7 to 9% annual rate. And again, this is one of those things where Advantest holds a bigger market share. I think Teradyne's, as the most recent quarter, last couple of quarters, was around 37%, and they think that in 2023 they can get a little bit more of that back. So maybe increasing from 37% to maybe like 40 or 45 or something like that is what they're looking for. But to have such a high barrier to entry, and the fact that there's only 2-3 competitors realistically that dominate the majority of the market share, means that, if you're a company that needs this equipment, you're going to Advantest or you're going to Teradyne. Whoever's going to give you the best deal, or whoever has the better technology, that's what you're going to be looking for when you're actually going to make a purchase, or increase your CapEx around this area. Now, another thing that I had pointed out in my, the article and the things that I did for KLA was the fact that they see that service revenues is going to be such a huge component of KLA's business. And that made me think about Teradyne, because all these companies are going to have equipment that realistically should last for years and years and years. Unfortunately, I couldn't find anything that showed like the backlog of how long this equipment's been sitting out for, like I had for KLA. KLA had had backlogs going 18 years back, that pieces of equipment that are still being used today. But looking at Teradyne, I wanted to look at the service revenue, and I really do think that this is also a big piece of the component as far as sales go, because again, it's a really high margin piece when you have to send someone out and actually have them work on the equipment, do some sort of servicing or anything like that. So popping up here, you can see that the service revenue as far as the product revenue. So the service revenue for 2022 was actually $563 million versus the $3.1 billion in sales that they made in total. So that's a pretty big portion of this business. And honestly, to see that, it's about 15% of their, revenue. To see that could probably increase a lot more as they continue to put out more equipment, put out new robots, and have to service more and more items. So that's something that I'm really looking forward to seeing too, is the growth in the service side as well as the product side. Obviously, again, if they're going to grow the robot side, that's a lot of companies, it's a lot of companies buying your equipment. That's also a lot of services that you need to do for equipment that doesn't necessarily work perfectly every single time. So I'm excited to see what they do with that. Now, as far as weaknesses go, one of the things that you're probably going to see from most of these semiconductor equipment companies, most of these semiconductor companies in general, is the fact that they rely so heavily on the East Asian countries. So China, Taiwan, they make up such a large proportion of the sales for this company. You can see the rest of the companies here, or the rest of the countries here, what they actually make up. So the top three is Taiwan, Korea, and China. And to see Taiwan and China basically make up almost a third of your sales when you have things coming out like the government banning, certain equipment or advanced test equipment or anything like that, that's a little scary. But it's something that I wanted to point out because I feel like it's necessary to, take a look at, make sure you understand what they're operating within. And it's something also that the government in the United States, at least, is actively going after a lot of these companies and making sure they can put up sanctions or put up some sort of tariff or something to make sure that we're not selling equipment to other countries that we don't want to. So that is something that I wanted to add because I think that the strained relationship with China and Taiwan, strained relationship with China and the United States could play a big factor in making or generating sales in foreign countries, because it could also help introduce new test equipment that comes from a Chinese manufacturer as opposed to an American manufacturer. Another piece that I wanted to mention as far as, weaknesses go, and I don't think that this is currently necessarily a big weakness, but it's something that happens in technology companies in general because they have to keep up with the product cycles. They have to keep up with the new products that come out. I think that looking at R&D as a percentage of spend as far as revenue goes, you need to make sure that we're not overspending. Now, I didn't see that R&D tipped over 15% of sales, so I'm not too concerned now, but it's something that I'm watching because when you have, a constant spend on products and you have to continue to keep up with the technology, they're going to spend a lot of money on engineers. They're going to spend a lot of money on, stocks for engineers or stocks for the executives and things like that to keep them from going to another competitor, going to another equipment company. So it's something that you should pay attention to when you're looking at this. You just look at the R&D as expense as a percentage of revenue, and just make sure to keep track of that quarter after quarter. Now, the last thing that I wanted to point out as far as a weakness, and then we'll dive into the valuation, is really what I think of, the concentrated market that they're operating within. Again, it's not really surprising. It is a risk that they point out on their 10K, but let's dive right into it. So the market for our products is concentrated with a limited number of significant customers, accounting for a substantial portion of test equipment purchases. In each of the years 2022, 2021, 2020, our 5 largest direct customers in aggregate accounted for 26, 33, and 36% of our consolidated revenues, respectively. We estimate consolidated revenues driven by Qualcomm, a customer of our semiconductor test, system test, and wireless test segments, combining direct and indirect sales to Qualcomm, accounted for approximately 11% of our consolidated revenues in 2022, and less than 10% in 2021 and 2020. We estimate consolidated revenues driven by one OEM of our semiconductor and wireless test segments, combining direct sales to the customer with sales to customers' OSATs, accounted for less than 10% of our consolidated revenues in 2022, and 19% and 25% of our consolidated revenues in 2021 and 2020. Again, having a concentrated market, having a foreign market, these all introduce different risks that I think people need to take into account before you decide to pull the trigger, or you need to do a deeper dive on this company to understand how they operate, what they operate within. And because there's only 2 people in this market practically that are selling test equipment as far as the semiconductor test and wireless test and system tests, those kinds of things, it helps that there's only 2 or 3. There's really only 2 major players, but it helps that there's not like a bunch of competitors in that space, because it's not highly growing. You might not see someone else step in as a third competitor, but it's still something you want to pay attention to. But I think as far as a concentrated market goes, this now becomes a company where you can't just watch Teradyne's numbers. You need to watch Qualcomm. You need to watch TSMC. You need to watch these other companies that are the big customers to make sure that nothing happens to them that's going to impact Teradyne's backlog or impact Teradyne's, just sales in general. Now, diving over into the valuation, I'm really excited for this one. Again, this is something that I've been following. I unfortunately had a whole semiconductor list that I wanted to go through. I didn't make it all the way through back in October of 2020, actually. So I missed out on KLA, missed out on Teradyne. ACLS was the other big one that I missed out on as well. But that's why I still want to learn about these companies to be able to be ready for the next time. And maybe I find another opportunity that's not on the list originally that comes from something like reading these 10Ks and doing these analysis. So looking at the valuation, though, you can see here they had 155 million shares outstanding. It's a $3.1 billion revenue. Current market cap is about $15.2 billion. Current share price is 97. The estimated free cash flow from what I was grabbing was 561 million. Total net income was 715 million. Now, if I scroll down to the numbers that I'm looking at, I think that their growth is really going to be anywhere from 5 to 10%. 10% being on the high end, 5% being on the low end. Again, if something happens to the whole market, these numbers are going to be totally wrong. I mean, they're going to be totally wrong anyways, but these numbers could really be totally wrong if something happens to the semiconductor test equipment or just market in general. But again, 5% on the low end. Profit margin is 20% on the low end, as well as free cash flow. And then on the high end, I have 26% for the profit margin, 25%. The terminal PE, I think, is going to be around 14, and same with the price of free cash flow. It seems to be trading in line, so I kind of put these the same. The terminal PE on the high end is going to be 20, and same with the free cash flow. Now, the discount rate I'm using is 12.5%, and really what that comes out to is an 83.54 fair value. Now, today it's trading again at $98. At $83 where I think the fair price is at, and from when I was originally looking at it, that's where I thought it was at, and still looking at it today, that's where I think it is as well. So if it gets down to the 80s, low 80s, I'm going to start getting really interested, and if I end up, acquiring any shares at that price, I'll make sure to let you know when I do those portfolio updates monthly. But you can see here that spread between the worst case and best case. On the worst case end, $56. On the highest case end, or the best case end, $123, what I think it's worth. So again, it's either goes down a lot, or it's probably worth a little bit more. So I'd rather take a little bit more downside protection by buying at a little bit lower of a price, rather than trying to make it work at $120 or anything below that. So right now, the downside for me as far as the fair value would be about 14%, until it, and that's when it would hit that $83 mark. But it's not an exact number because I'm not going to be 100% right. It's probably going to be way off from this number. And looking back, we can make a fair value, but looking at today's prices, we're just making a guess and trying to reduce the risk as much as possible when buying into companies. So again, we're buying companies. We like Teradyne as a company. We like the market that they're in. We like that the growth in the sector as a whole, between the semiconductor industry as well as the robotics industry. I think there's a lot of opportunities there. So let me know what you think down below. Also, if there's any semiconductor companies that you want me to look into next, let me know down below as well. But again, $83 where I think I'd start to get interested in, probably a little bit under $80. But I'm going to keep this one on the watch list. Going to keep the price alerts on there as well. But if I make any updates, I'll let you know in my portfolio videos. But with that being said, have a great day and happy investing.